Money for Nothing, Inside the Federal Reserve is an independent, nonpartisan documentary film that examines America's central bank in a critical yet balanced manner. We're pleased to have with us the producer and director of that award-winning film, Jim Bruce. Welcome to the Index Investing Show. Great to have you with us.
Thanks so much for having me.
There's still a lot of misunderstanding about who the Federal Reserve Bank is. Many people seem to believe that the Fed is part of the U.S. government. So who owns the Fed and where does it receive its funding?
The Fed is such a complicated organization. There's a portion of the Fed, the Board of Governors in Washington, D.C., that Janet Yellen is now the chair of. That is a government agency. She is a government employee. But then if you look at most of the rest of the Fed, all the regional banks, there's 12 of them scattered around the U.S., those are actually privately owned by the banks in each district that created that regional Federal Reserve Bank roughly 100 years ago in 1913. So the Fed is this strange mixture of public and private. They do give back 95% of the profits that they make, which are substantial these days with quantitative easing, to the U.S. Treasury. But then the banks get to actually keep a small portion of that. And the portion of the Fed that's doing quantitative easing, for example, which is run by the regional banks, those are private organizations. So it's a very strange mixture of public and private, and it creates a lot of confusion amongst a lot of people.
Jim Bruce, producer and director of an award-winning film titled Money for Nothing. His website, moneyfornothingthemovie.org. Go there, get the DVD. Also, if you are work at a university or if you'd like to arrange for a screening in partnership with Jim and the movie, go again to his website, moneyfornothingthemovie.org. That is available. Now let's talk about the Federal Reserve's policies and decisions that have, in fact, contributed to financial bubbles instead of preventing them. Now, they say it's not true. You say it is. Tell us more.
Well, if you look at what the Federal Reserve is supposed to do, they're supposed to make our system more stable. They're supposed to protect the value of the U.S. dollar from inflation. Lately, since the 1940s, the Fed has seen it as its mission to help the economy grow in a smooth and balanced way, and to boost employment. And that's what the Fed is supposed to do. But if you look at what Fed policies have actually done, especially in recent decades, we argue in the film they've contributed to more financial volatility, to greater swings. For example, in the 1990s, many critics inside and outside the Federal Reserve think the Fed left interest rates too low during the stock bubble, bailed out long-term capital management, a big hedge fund in 1998, worried about the transition to Y2K, pumped the economy full of money in 1999, and that helped contribute to the stock bubble. And then again in the early 2000s, holding interest rates very low in the midst of the largest U.S. credit boom, in history. Many people from Paul Volcker on down in our film argue that was a big mistake. So that the Fed, in some cases, with maybe the right intentions of trying to smooth out cycles, has actually extended a lot of economic and financial market cycles, and made the booms bigger and the busts bigger.
Jim Bruce, producer and director of moneyfornothingthemovie.org. Pick up a copy. Now, one of the points made also in your documentary is how the Federal Reserve has shown this consistent pattern of intervening into financial and economic matters that have nothing to do with its original purpose for existing. Talk about that.
Yeah, when the Fed was created in 1913, it had a very narrow mission. At that time, inflation wasn't actually even something the Fed was supposed to be involved with, because we were on the gold standard, and it was assumed we'd always be on the gold standard. And so the gold standard was going to take care of inflation. The Fed was really just there to intervene in banking panics, to provide currency to banks when they needed it and couldn't get it from each other, when banks essentially stopped lending to each other, as has happened at different times in our history. So the Fed had a very narrow focus when it was originally established, and like a lot of government organizations, they've sort of taken on more and more tasks and sort of given themselves more and more power to the point where you could argue today they're the biggest influence on the U.S. stock market, the U.S. housing market, the U.S. government bond market, where they own twice as much debt as China, for example, over $2 trillion in U.S. debt. So that's one of the concerns we express in the film, is that the Fed is trying to do too much, and we sort of as a nation are relying too much on our central bank.
Alan Greenspan, the retired Federal Reserve chairman, played a key role and a direct role in the U.S. housing bust and subsequent financial crisis that followed. We know that he denies that, but he can't live that down. Now, Ben Bernanke came in after him to kind of clean up the mess. Do you think Bernanke made things actually worse?
I mean, that's one of the concerns that a lot of people express in the film. Viewers are often surprised by who's criticizing it. There's a lot of people at the Fed now, and there's people like Paul Volcker, who is a former chairman, who are critical of what the Fed is doing today. And I think the big thing is you have to look at it in a short-term, long-term perspective. And in the short term, I think you could argue that Bernanke sort of did help to end the crisis and sort of pull us back from the brink where, in 2008 and 2009, the financial system really was ready for collapse. But then in the long run, I worry, and people worry in the film, that Bernanke's potentially placed us on a path to another bigger crisis down the road, because his policies have just papered over with trillions of dollars the problems that we have, rather than fixing them and addressing them. And I think it's the same thing with Greenspan. In the early 2000s, the Fed was very proud that they had, solved the problem of the collapse of the stock bubble, not realizing they were creating another, much bigger problem. And I'm worried that that's what we're doing once again.
If you'd like to arrange for a screening in partnership with a local university or another organization, with the Jim Bruce, the director and producer of this wonderful movie. It's called Money for Nothing, themovie.org. That is the website, and you can pick up also a DVD there. Go there. Now, I want to ask you, Jim, one of the things that sometimes gets missed is that before the Federal Reserve made its debut in 1913, there were actually 3 central banks that preceded it, and all of them failed. The second bank of the U.S. lasted just 20 years. So what do you think about the spotty history of central banks? What does that teach us about the future?
I think that's one of the concerns, is that if you look at currencies that haven't been backed by anything, they've failed throughout history. And yes, a lot of people don't really realize the U.S. has had central banks before. In those cases, we eventually got rid of them. The political system, members of Congress began to view the central banks and Andrew Jackson famously in the early 19th century as sort of protectors of the rich and politically well connected, and that's what brought about their end. And one of my concerns is that the Fed, its current policies are unsustainable, and it's sort of playing into the hands of everything that people feared about central banks when the Fed was first created. The Fed has in some ways become. I think it's easy, as an investor, you're used to the current situation you're in. You assume it'll continue for a long period of time. So I think investors today are very complacent. They feel, the Fed's going to protect me, so I can, pretty much buy stocks or bonds, and the Fed is going to come in if those things lose their value and support financial markets. And I think that's been the case recently. But if you look at history, the types of policies the Fed is practicing today, aren't the types of things that can go on indefinitely.
Now, Jim, even though they're no longer active voting members of the Federal Reserve, how much of an influence do you think that ex-Federal Reserve people like Bernanke and Greenspan have on Fed decision making today?
I think they have a significant influence. I think especially Bernanke, I think his speeches and his opinions and maybe some papers that he might write in the future will be taken very seriously in Federal Reserve circles. I would argue they shouldn't be taken quite as seriously. But I think the way to think about it is that there's a group of largely academic economists who work at universities and think tanks, and in some cases in the private sector, but they're largely not in the private sector, who really determine and develop the ideas and theories that central banks use to and models, which unfortunately are often wrong, that economists use to develop policy at the Federal Reserve, and to call for changes in policy at the Fed. They present papers to each other at conferences, and they work in a very sort of traditional academic way. The big problem is that a lot of those theories have failed in reality in recent years, and so I worry there is an influence from the thinkings of people like Greenspan and Bernanke that continues on Federal Reserve policy. I just worry that it's sort of the wrong ideas, and they're ideas that might work in theory or might work in a complicated mathematical model, but don't work when you involve real people trading in financial markets and living their everyday lives.
One of the things I think that's worrisome on a global scale is that the Fed's relative success with the quantitative easing experiment has actually emboldened other central banks around the globe to embark upon the same path. In Japan they're doing this, and then of course in Europe they're looking at doing this. I mean, what type of destabilization could that cause on a global scale?
I mean, I think that's the amazing thing about what the U.S. is doing is that now every other developed economy is doing it to some degree. In Europe and Japan. If you take the
monkey
U.S.,
see,
Europe,
monkey
Japan,
do.
That's pretty much the whole developed world is doing the same thing, and so there sort of isn't. One way I think about it is that there's a bunch of trains, central bank trains, that are all moving at 200 miles an hour, and we're moving parallel with each other. So if you look over at Europe or Japan, it seems like they're kind of moving relatively slowly, no big deal. But the reality is we're all sort of hurtling 200 miles an hour down a track that we've never been down. So I worry that it's just like I said earlier, it's going to increase volatility in financial markets. Ultimately, in recent years, in the short run, financial markets have been boosted. They've been going up steadily, 20 or 25% a year in a lot of places. But I would argue that that's sort of that's the good part that we get for a while, and then down the road we see the crisis brought on by these huge, distortions in balance sheets and mispricing of government bonds around the world. For example, you have Greece today borrowing at very low rates. I forget what they're down to on the 10-year. Maybe it's it could be 5% or something like that. And Greece is a country with huge problems. It's probably eventually going to default. So those bonds are being mispriced. But in the short run, people think, oh, things are better. Greece is borrowing cheaply. Everything's okay. But we've seen that Greece borrowing cheaply, in the early and mid 2000s was ultimately not a good idea. So it's that thing that investors have to do is try to figure out how to profit in the short run, but sort of protect themselves in the long run.
Yes, great points, and also a great interview. Money for Nothing, Inside the Federal Reserve. Great film. You just heard from producer and director Jim Bruce. Go to moneyfornothingthemovie.org, get the DVD, and also if you'd like to arrange for a screening in partnership with a local university or another organization, get in touch with Jim. This is the Index Investing Show. I'm Ron DeLegge. Thanks for listening. Go to indexshow.com/podcast to listen to the rest of the show.
The Index Investing Show with Ron DeLegge.